Welcome to The Explainer. Today, we're going to crack the code on the single most important principle in all of accounting. I'm not kidding, this is the one rule that literally runs every single business on the planet. So think about it. How can one simple little formula explain everything? I mean, from your local coffee shop all the way up to a massive global company. Well, that's what we're going to get into. We're about to explore an idea that is, truly, the foundation of all finance. Okay, so to really get this, we have to start with one simple but honestly pretty profound concept. And it's this: a business is totally separate from its owner. You got to think of it like it's its own person, right? With its own legal identity, starting its life from scratch, from absolute zero. And here we go. This is what that looks like. On day one, before anything has happened, I mean, not one penny has come in or gone out, our brand new business is perfectly balanced. It owns nothing, that's zero assets. It owes nothing to anyone else, zero liabilities. And it owes nothing to its owner, zero owner's equity. A clean slate.
All right, section 1. So with that foundation set, let's break down the 3 core components, the 3 building blocks that make this whole thing tick. And believe me, these are the only 3 pieces you really need to know.
First up, assets. Don't let the fancy word fool you. This is just all the valuable stuff the business actually owns. You know, we're talking about cash in the bank, the company car, the inventory sitting on the shelves, anything with monetary value. Okay, next up is owner's equity. Now, this one can feel a little weird at first, I get it, but all it is what the business owes back to its owner. It's basically a record of the owner's investment in the business, the money they personally put in to get the whole thing off the ground. And the third piece of the puzzle? Liabilities. This one's pretty straightforward. These are just the debts the business owes to other people, anyone who is not the owner. So think a bank loan or money you owe a supplier for stuff you bought. So here's the magic. When you put those 3 pieces together, assets, liabilities, and owner's equity, you get the golden rule of accounting. And here it is. Assets equals liabilities plus owner's equity, always. You know, a really simple way to think about this is that everything a business owns had to come from somewhere, right? It had to be funded by someone. So what the business owns has to equal what the business owes. And it only owes 2 kinds of people. Outside parties, like a bank, that's a liability, or the owner themselves, and that's the equity. Okay, so that's the theory. But theory is one thing, right? How does this actually work in the real world? Well, let's watch this equation in action. We're going to follow the story of a new entrepreneur named Anita. So, Anita's ready to start. First thing she does is take $56,000 of her own money, her savings, and puts it into a brand new business bank account. Boom, that's transaction number 1. And look what happens. Instantly, the equation is in perfect balance. The business now owns an asset, that's the $56,000 in cash, and where did that cash come from? From the owner, so the owner's equity is also $56,000. The 2 sides of the equation match perfectly. All right, what's next? Well, the business needs a vehicle to make deliveries, but Anita's smart. She wants to hold on to her cash. So instead, the business buys a $6,000 vehicle on credit. It's basically just an IOU. This creates a new debt, a new liability. And watch what happens to our balancing act. The total assets of the business just went up by $6,000 because of the new vehicle. But to keep things balanced, the liabilities also went up by that exact same amount. See, the scale is still perfectly level. Okay, fast forward a few weeks, Anita's business is doing well, and she decides it's time to pay down some of that debt on the vehicle. So the business takes $5,000 of its cash and makes a payment. Now this is going to affect 2 things, an asset and a liability. And this is such a brilliant illustration of how this all works. It's just shifting value around. The cash, an asset, went down by $5,000, and the debt, a liability, also went down by $5,000. One side goes down, the other side goes down. No matter what you do, the equation holds true. It always balances. Okay, so we've got the basics down. Now we can add another layer of detail, just like a real accountant would. This helps give us an even clearer snapshot of a company's financial health. You see, not all assets are created equal. Accountants like to split them into 2 groups, and it's all based on time. You've got current assets. These are things you expect to use up or turn back into cash within a year, like, well, cash itself or your inventory. Then you have non-current assets,
And these are your long-haul items, things you'll use for more than a year, like vehicles, buildings, or big machinery.
And guess what? The exact same logic applies to liabilities. They're also split into current and non-current. Current liabilities are the debts you need to pay back soon, within 1 year. Think of an invoice you owe to a supplier. And non-current liabilities? Those are the long-term debts, like a big bank loan that you've got several years to pay off.
Okay, we've covered a lot. So what's the big takeaway here? What's the one core principle that makes this whole system so unbelievably reliable? The big secret? It all comes down to something called the dual effect principle. And here's the key idea. Every single thing that happens in a business, every transaction has two effects, two changes that perfectly cancel each other out. It's impossible to change just one number. If an asset goes up, something else has to move to keep that scale balanced, period.
The source material really nails it with this quote. Every single transaction leads to two changes. Just let that sink in for a second. This isn't just a suggestion or a good idea. It's a fundamental, unbreakable law of bookkeeping.
So if you remember one thing, remember the number 2. There are always two sides to the story, two effects for every action. And that's what ensures the financial scale never, ever tips out of balance.
And that leaves us with a pretty interesting final thought. If this whole system, this equation, is basically the ultimate error detector, what does it really mean when the numbers don't add up? It suggests that the balance isn't just about the math. It's about honesty. It's about the integrity of the whole story a business is telling.